Welcome to Season 3 of the Knack for Business podcast. Over 350 episodes strong, we're here to ignite your entrepreneurial spirit with fresh insights, networking gems, and creative strategies that elevate your game.
How do you confidently invest in commercial property without making costly mistakes? Fred will dive into how to avoid common investment pitfalls, choose the right ownership structure, understand leverage, and build a real estate portfolio that works for your business goals, whether you're just starting out or ready to scale. If you're trying to make smarter property investment decisions or want to stop renting and start building equity, this episode is for your next smart move. Listen and take the guesswork out of real estate with Fred's trusted real-world guidance. Our guest today is Fred Crouch from Gentry Learning and Property Wizard podcaster, broker of record, managing director of Gentry Real Estate Services, and the voice behind the Property Wizard podcast. With over 35 years of trusted experience, Fred helps investors and institutions navigate the world of commercial real estate with clarity, confidence, and integrity. He's a certified expert with credentials like FRI, ACOM, CPM, and CLO, and much more, and has handled everything from distressed properties to government asset recovery. Through Gentry Learning and his popular podcast, Fred demystifies complex investment topics like turning leaseholds into freeholds, so everyday investors can make smarter decisions. He's a tireless community contributor, having donated blood nearly 100 times and served on multiple nonprofit boards. If you're looking to invest wisely, manage risk, or simply understand your real estate options better, Fred's insights are your next smart move. Fred, welcome, sir. It's good to have you back. Do you have a favorite quote or saying?
Well, it's wonderful to be here, number one. I have a favorite quote or saying. I probably have several, but the one that I use most often is that if there are no problems, there are no opportunities.
So what started you down the investing inside real estate? I mean, it's one thing to be able to sell and buy for somebody else as a broker and running a firm, but why investing? Like, what brought you into that space?
That's a long story, probably longer than what this podcast will allow. But to make a long story short, all good stories, there was a woman involved. In this particular case, I was in my late teens, and this particular woman's father, a Greek immigrant, came to this country with pocket change, really. He was a hairdresser by trade, and what he did was lease a small commercial space on Bank Street. I mean, those who aren't from Ottawa would know where that is, but it was a very high-profile location. He ran that hair salon for the longest time until the building was made available for sale. So he, with his hard-earned money, bought the building. It was his first real estate acquisition. Fast forward 9-10 years, and he acquired a portfolio which in today's dollars would be worth hundreds of millions. He was at one point in time probably the area's largest private landlord, accumulated probably a score's worth of buildings. And it was really quite amazing because he had no formal education, but he had made a success of himself through real estate investing, following some very, very basic principles. So I, being a young, arrogant teenager, said, well, boy, if he can do it, I most certainly can do it. And that started me thinking. I really started to educate myself on what was involved when it came to investing in real estate. And just as a bit of an aside, I remember in Ontario, Canada, when high school was grades 9 through 13. You had a formal discussion with your guidance counselor about what courses you were planning on taking when you entered university. And I can remember distinctly sitting down and speaking to my guidance counselor. She asked me what I wanted to do with an eye towards what courses I should take when I went to university. I told her point blank, right then and there, I want to sell and buy real estate. I remember this look of complete disdain on her face, saying, why do you want to do that? You could do anything you wanted. Everybody is selling real estate. I said, well, I just don't want to sell real estate. I want to buy it. I want to own it. And she really discouraged me. I don't know why, but so much so that I went through university. I was never really happy going to university because I was continuing to educate myself when it came to real estate investing. Before I graduated high school, I bought my first property and I had an eye towards buying and expanding my portfolio. After a few years of university and not looking at things seriously when it came to real estate, I decided to take the plunge and get my real estate license. From there, I haven't looked back. That's how I started. I mean, there's a lot of sidebars that we could talk about, some of them rather funny, but at the same time, that's the genesis. That's why I figured, well, if, my, at that time, potential father-in-law could do it, I most certainly could. And that bodes well for the arrogance that a young teenage boy is at this stage of his life.
I find it interesting that city planners change what they're looking for over the years, and then the developers end up having to live with what the city planner came up with. The multi-use building where you have stores on the ground floor and 4 to 5 floors of apartments above got very passé. Everyone turned on this. Says, no, we're not doing that. How do we bring them back? Are they back? What killed them? That seemed like the highest and best use.
In today's reality, cities, at least in the province of Ontario and several other provinces, and I would imagine states too, are mandated to provide certain types of housing, usually affordable housing, as part of their official plan. City planners work through and by an official plan that's usually open to public consultation. It goes through a rather rigorous process. A lot of these city plans were thrown into the shredder once the province mandated you must promote infill over and above new lands or new subdivisions. So essentially, what they're really promoting is intensification. You're right in your observation that mixed-use properties at one point in time weren't really what people were looking for, because there is a divide. You'll find that investors generally, they're either residential investors or they're commercial investors. Part of the reason for that is residential properties can be more management intensive. And you're dealing with outside authorities as well, landlord and tenant boards, for instance, the provincially or stateside mandated regulations that at times restrict what a landlord can do in the case of a default. That's very different when you compare it to a commercial property. Most jurisdictions, a commercial property, if the tenant falls into default, the landlord has the absolute right to change the locks. They'll usually give notice as a matter of courtesy, but they can go in and change those locks. You don't have to go through a whole process. You don't have to go through a hearing. If you don't pay your rent, you're in default of your lease, and the landlord has the right to change locks and lock you out. What's happening is because intensification is being mandated, mixed-use properties really are making a comeback. Most of the high rises being built will have a retail component on the main floor, which was unheard of 10 years ago. Mixed use is coming back with a vengeance. A lot of it is because of the mandated intensification requirements. The main floor retail units are big and bright and, have walls of windows and really kind of lend to a different type of atmosphere. So it's not your, historically speaking, mixed use project where you'll have maybe a building that was built. Let's say you have a 2-story building with apartments that was originally built with apartments on the main floor and apartments on the second floor. And what's happened, they've kind of redeveloped the main floor so that you've got these small little cubicles, essentially, or residential apartments that are made into commercial units because they've cleared the floor up. That's not really the same type animal, but you're right in your observations. Mixed use really kind of fell out of favor because it wasn't a very good product. But because of the EU legislations and projects happening now, it makes perfect sense to have large, bright, and I'm talking about retail units that have high, 10, 12-foot ceiling heights that are bright and windows all around the main floor and really kind of give it a sense of, it gives it its own character. The local ZB development is prime with that type of property. I've shown property there to prospective tenants on several occasions, and the units, beyond a doubt, are very attractive. It's not a little closed-in cubbyhole on the bottom of a building that wasn't built to house that type of unit. They're making a great comeback, and I really applaud the developers who are doing a great job at it, making it very attractive. One last point. It's also important to these developments, particularly going back to ZB or any other major residential construction projects, that they build a community around the development so that you can live and play in your neighborhood. So it's as easy as turning around and getting in the elevator, going down to the main floor and choosing a restaurant. Drugstores and professionals like the dentists, for instance, they're gobbling up this space in these buildings because it's like you have a built-in clientele.
You just highlighted a really interesting point. Things change. And you have a course out there that talks about different elements. You have a course that helps dispel myths. But at the same time, it also talks about what type of investor are you? Are you active or passive? So let's say someone wants to buy part of a building as a co-tenancy or in its entirety. What are the pros and cons? Are they an active investor? Are they passive? Are they going to be hitting some expectations that aren't going to be real for them? Hence the myth.
Another loaded question.
You're welcome.
Let's talk about what makes you an active or a passive investor. It's all about comfort level. For instance, one of the biggest or the largest or most often objection to owning real estate is that they don't have the time, they don't have the management expertise, they don't want those 2 a.m. phone calls from a tenant saying they've lost their keys and can't get into their unit. That's old-fashioned thinking in today's day and age. That goes back to the previous question Dwayne put forth about commercial versus residential. Generally speaking, it's the residential component that many investors just don't want to have anything to do with because they don't want those problems. They don't want those issues. They don't want tenant problems. If we look at it logically, someone who wants to buy residential property is usually a fairly active investor. They're involved. But you're kind of confusing two different issues here. Co-tenancies allow you to buy that type of property that a more involved investor would get involved with, even if you're a passive investor, for the simple reason that when you enter into a co-tenancy, the co-tenancy is dictated by what we call a co-tenancy agreement. And more often than not, it stipulates that the property being purchased by the co-tenants is managed by a third-party manager. That can be a member of the group if they have the expertise and the ability to do that. So it kind of takes away either that objection or that fear component of investing in real estate, primarily residential real estate. By getting involved in a co-tenancy, you can sidestep a lot of those issues. And a co-tenancy will work whether you're an active investor, like you want to be involved, or a passive investor and are happy to invest in real estate, but really don't want to do or take care of the day-to-day items or situations. So co-tenancy is a great way to get around that. But what dictates whether you're a passive investor or an active investor is your comfort level. If I have an individual who is passive and doesn't want to have to deal with those situations, and they want to buy the property on their own, I would probably suggest that they move or they buy more of a commercial-oriented type building. That's what I would do. However, if a great opportunity comes up and they know they don't need to get involved and they don't mind working with a group, then a co-tenancy is the way to go. And Bob's your uncle. You can utilize the format in most any kind of real estate investment. Does that answer your question? I mean, it was a loaded question to begin with. I'm feeling like I missed something.
You touched on several different things. Your Property Wizard podcast, right, where you talk about different elements. Also speaks to taking the course, understanding, like, do you want to play? Do you want to hold the mop? Do you want to hold the plunger? Here's money. Please manage it. I don't want to get a call at 2 a.m. for lost keys or wayward raccoons.
All right.
I would say an interested outsider is something you just spoke about, but I don't think people understand. What is a co-tenancy?
What is a co-tenancy? A co-tenancy is a group of individuals who invest in a property together. Now, you need to delve into that just a little further. The first thing that I like to point out when asked that question, what is a co-tenancy, is I compare it to joint tenancy. And usually what happens is that people's heads start spinning and they say, well, hold on, I don't even know what a co-tenancy is, but what's a joint tenant? The joint tenancy is what you would have if you and your significant other, married or not, bought a piece of property together and it became your primary place of residence. The primary difference is that upon your demise, should you pass away, and if it's a joint tenancy, that interest in the property that you own reverts immediately to the surviving spouse. And I'm using spouse as a catch-all for significant other. So that means we're going merrily on our way and all of a sudden Bernie crosses the street and God forbid he gets hit by a bus. That means that Lisa would turn around and inherit. It's not even an inheritance. It's she would own the home. There doesn't have to be any legal footwork or anything else. You're joint tenants. You own it together. And if one spouse dies, it immediately reverts to the surviving spouse. It's as simple as that. However, with a co-tenancy, what happens is that same scenario, that individual's interest. Again, let's use Bernie. He's an easy target, lovable target, easy target.
Thank you. I like another bus, right? Another bus is coming up in my future.
Your interest doesn't immediately revert to your spouse because it can be held, and this is the second point, it can be held by a corporation. It's transferable. It's a divisible interest on a percentage weighted scale. When you're a joint tenant, you own the house. It's not a matter of dividing it down the middle and saying, well, I own this bedroom and my spouse owns this bedroom. It's indivisible. But when it comes to a co-tenancy, it is divisible. It just means that your interest on a percentage weighted scale can be held separate. It can be held by a corporation. And should you pass away, it becomes part of your estate and doesn't immediately transfer to your spouse. So it's divisible, it's transferable, you can sell it. These are all things that you can do in a co-tenancy. But when you're joint tenants, no, you don't have that option. If you pass away, your spouse inherits your interest in the property. There's a lot more involved, but generally speaking, if you own a property, any property, it doesn't have to be your home, but if you own any property yourself, both you and your significant other own another property, you would be 100% responsible for the upkeep and maintenance on that property. So let's say you own a nice fourplex, but the roof needs to be replaced. Whether it's a flat roof or a shingled roof, it doesn't matter. Let's say all of a sudden you're looking at a $30,000 bill, which would not be outrageous either way you look at it in today's market. So in a joint tenancy, or any type of ownership of a building in that matter, whether you own it alone or whether with your spouse, you're going to have to come up and write the check for that amount. So if it's $30,000, guess what? You got to write a check for $30,000 and cover that expense. But when you're involved with the tenants in common, and let's say you have co-tenancy agreements, again, another term is tenants in common. Again, I don't want to convolute the issue. That repair, that $30,000 repair, is the responsibility of everyone severally, in the sense that if it's $30,000, you have 6 partners, every partner needs to come up with $5,000. So that's one of the benefits to being involved with a co-tenancy situation. What ends up happening is that you can afford to extend your investment dollars further and expand your portfolio faster, because you're not the sole individual carrying the freight. I always use the illustration of a roof. You own the building yourself, whether it's just you and your spouse or you, it doesn't matter. You got a $30,000 bill to repair that, you're the one that has to pay for it. If you're involved in a co-tenancy, you have the same repair. What ends up happening is that each partner is responsible for their proportional share. There's a huge benefit in that. Not to mention the fact that you don't need nearly as much money. If you're going to buy a property in today's day and age, if you buy a property for $1.2 million, we usually like doing co-tenancies with little to no mortgages on them. So in that case, we may put 12 individuals together with $100,000 each. Very rough calculation. Let's say there isn't any mortgage involved, just for the sake of this illustration. You, as a co-tenant involved with this group, would put down $100,000 to buy a 1/12 interest in that property. If it was an all-cash transaction, you'd have to come up with $1.2 million, but no one would ever do that. And this is where leverage comes into play. You'll still have to put down maybe 20, 25%. There's so many different rabbit holes of directions we can go. I'm trying to keep it simple. If there's a vendor take back mortgage involved, chances are you can get a higher loan to value ratio. And essentially, on commercial loans in this country today, you can usually get, if it's non-owner occupied, that's very important. If you're buying it as an investment, you can get anywhere from 60, 65% loan to value ratio. Some lenders, if they like the property, might go up to 70. So going back to the $1.2 million purchase example, you would be required to come up with $360,000 as your down payment to a new first mortgage if you were buying that property yourself, versus getting involved with a co-tenancy. Again, it may not be a requirement of the group that it be paid for all in cash. Maybe you're arranging a 50% mortgage. And in that case, you come up with $600,000 and the balance is financed. So that would mean if you had the same 10 partners, you only have to come up with $60,000 versus the other illustration we had where you had to come up with $360,000. Does that kind of make sense? So 30 versus 360. Big difference.
I want to focus on something here. If I'm looking at, I want to invest money somewhere. I can find a TFSA account. For those in Canada, that's a tax-free savings account. A certain percentage coming back. The money's parked in there. Actually, it's not a pot of gold, so to speak, to look at. When you there's tax implications, when you're investing. And once you buy something, to leverage the property also means as it ages, it appreciates. Would these all be truisms? And how do you shape then? Here's $100 or here's $1,000,000, whatever amount of money. For most people just coming into the story, they're looking at what happens next. You describe it, you get a co-tenancy going, okay, what happens next? So what should they be expecting to understand as for growth, asset awareness? And I think you pointed out in the past, you can actually point to what's of value as opposed to cash, which is in Bitcoin, Ethereal, whatever.
Yeah. So again, you've touched on a few things there. The first thing I need to say is that I am not a financial planner. It's very difficult for me to comment about anybody's financial situation or the tax implications that are related to them. For the very simple reason that everybody is different. You may choose to decide to buy a piece of real estate, but how that affects everything else that you have going on at what tax rate is a question I cannot answer. You need to have a financial planner, an accountant, someone you trust to administer all your personal holdings, TFSAs, RRSPs, whatever. So I'm not really qualified to make that judgment on behalf of any investor. I'm just trying to think of a path that would work to answer your question. At the end of the day,
I think the path is in your course, you talk about you surround yourself with a team. Each is a subject matter expert, lawyer, accountant, tax, etc. Building, someone who assesses the building for its viability, those elements. The other piece I want to focus on is you put your money in there and it starts appreciating, which is a hell of a lot better than a TFSA, right? Your bank account will creep up half so slowly, right? As opposed to there's a good chance that your property value after 5 or 10 will bloom.
okay. And
The reason with sound advice, the idea is where do I drop my cash? Why do I put it in real estate investing? What are the upsides?
again, you're asking a very, very loaded question that's very difficult to answer.
He did that.
Let's break it down. One of the magical things about real estate is something called leverage. If you take nothing more away from this discussion than that word, I think that really is the most attractive thing about real estate. Leverage allows you to put down a portion of a purchase price. For instance, let's say you're buying $1 million property, and let's say you put $200,000 down on it. It can be your own residence, it can be a rental property, it can be a whole host of reasons. But at the end of the day, let's use that example. So leverage allows you to, with a portion or a relatively small percentage of the purchase price of that asset, to buy the asset and realize market appreciation to benefit from the increase in value of the asset as a whole. So let's take that $200,000 and put it in a TFSA. And let's say you're getting a phenomenal guaranteed return of 6%. That's $12,000 a year. That's pretty damn good. In today's day and age, long gone are the days of 14, 15, 16% interest, knock on wood. But let's say you could take your money, not buy real estate, take the $200,000 and get 6%. That's $12,000 a year. Perfectly fine in anybody's book. But let's take that same amount of money, buy a property for $1 million, and let's say you have market appreciation of, let's be very conservative and say 3.5%. Remember, you're not getting 3.5% on the 200,000. You're getting 3.5% on the million. So you're getting $35,000 in return versus $12,000. So that's the magic of investing in real estate. So when it comes to your net worth statement, after year one, you've bought a property for $1 million and you've realized a 6% return. So at the end of the day, at the end of year one, that building is now worth $1,060,000. Everybody follow the math, 6%, $1 million, $1,060,000. Versus, let's take a look again at your net worth statement. You had $200,000. You got the same 6%. That's gone up by $12,000. So what's the difference between $12,000 and $60,000?
A big number.
Well, it's pretty large. And that's the magic of real estate. That's what we speak about in the course. I spent a great deal of time on the topic because that's what leverage is all about. That's what makes real estate so very attractive. Most people would turn around and say, okay, my asset is worth X number of dollars now. But after you've owned it for a couple of years, let's say the building is now worth 1.5 million. If you take the same loan to value ratio that we used in the previous example of 80%, remember $200,000 down on the $1 million, $800,000 first mortgage. So all of a sudden, 80% of 1.5 is $1.2 million. So what does that mean? All of a sudden, you've got another $400,000 that you can take and invest in more real estate. Sounds pretty incredible, doesn't it? But that's the reality of it. Buy a property for $1 million, put down $200,000. Let's say you get a loan to value ratio of 80%, which may be a little higher than what you can get today, but it depends. There's so many different variables. It's not even funny. If you're a professional, for instance, a lawyer, a dentist, a doctor, and you buy a building, you'll find financial institutions falling over each other to finance that property. I sold an orthodontist a building not that long ago, and I think his purchase price was about $1.1 or $1.2 million. The banks that he went to financed that property. One offered 110%, another offered 115% of the purchase price. You're probably wondering why. Well, it's easy. They needed money for leaseholds. He's a professional. He's occupying the property for himself. So there's a lot of different variables when we talk about this scenario, but the harsh reality is that's the way leverage works. The earlier you start, the better, because time will work in your favor, given the examples we've just had. Sometimes you'll buy a piece of property, you've researched the market well, and all of a sudden you'll see your $500,000 investment worth, as so many people have during this recent, I'd suggest over the past 2-3 years, when it came to residential housing. A lot of people bought residential homes as a form of investment. Your home is, in most cases, your first and best investment. They saw values escalate. They may have paid $600,000 for their home maybe 3-4 years ago, and all of a sudden, 2 years ago, their home was worth $850,000. Now you've got a lot of extra equity that you can play with, and that's the magic of leverage. When it comes to investing in real estate, it is probably the number one reason why real estate is such a great investment.
Fred, you have a course, and you have a podcast, and you have clients that you'd like to serve. Tell me about those three things. How do we get a hold of you?
You can get a hold of me very simply you can look up the Property Wizard. It's on all major podcast platforms. Type in the Property Wizard and you'll see our portfolio of real estate related podcasts. I welcome emails. You can reach me, quite frankly, and the easiest thing to do is to just type in Fred, that's me, F-R-E-D, at Gentry, Gentry, short form for real estate services. So again, Fred, GentryRES.com. I always try to get back to you the same day.
Fred, I want to say thank you. I appreciate you coming back. We're going to have to ask more questions on another podcast because you'll be in for the fourth time, which is awesome. There's a boatload more of information. I want to say thank you to Wayne and the Knack for Business listeners. Fred's got over 35 years of helping people turn uncertainty into opportunity. He's been involved with transforming abandoned properties, distressed assets. Now you want to find out, what does that all mean? What is a distressed asset? Take a gander at the Property Wizard podcast. It's how to build your wealth. And it can be generational wealth. It can mean a lot to keeping you going, whether you're a passive income, a secondary income, or a primary income.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVISIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people: Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert; Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host; Jovan Strika from At Hive, a co-working space; Melanie Weber, Bernie's invaluable business partner; and Wayne Pratt from Motive 8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer: please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.